We need to talk about something that trips up a lot of people when they leave a job and decide to move their 401k. Maybe you've just retired, or maybe you've switched companies and you're thinking about rolling that 401k into an IRA. It seems simple enough, right? Move your money from one account to another. But there are a few easy to miss mistakes that can cost you big in taxes and penalties. So today, I want to walk you through 3 common mistakes people make when transferring their 401k and how to avoid them. I'm Kenney, Wealth Advisor with the Noble Group. I have more than 19 years of experience working with people just like you, and at the end of this video, I'll show you how to get a free video review from me covering your unique financial situation. Okay, mistake number 1, missing the 60-day deadline. This is one of the most common mistakes I see people make. Here's how it usually happens. You leave your job, and your old employer sends you a check for your 401k balance. You think, great, I'll deposit this into my new IRA soon. Then you get busy, you forget about that check, and a few months roll by, and then you suddenly remember, oh shoot, I never deposited that check. That's all right, it shouldn't be a problem, I'll just take care of it now. But here's the catch. You only had 60 days to get that money into an IRA until the IRS treats it like income. That means you could now owe ordinary income tax on the full amount plus a 10% early withdrawal penalty if you're under 59.5. To make matters worse, the check they send you is often short by 20%. Why? Because your old 401k provider is required by law to withhold 20% for taxes. So if you had $10,000 in your 401k, you'll only get an $8,000 check. To make the rollover complete and avoid taxes, you'd have to come up with the missing $2,000 out of pocket within those same 60 days. The simple way to avoid this? Always request a direct transfer, which is also called a trustee-to-trustee transfer. That way, the funds move straight from your 401k to your new IRA and you never touch the money. No taxes withheld, no 60-day deadline, just a clean, tax-free rollover. The second mistake, rolling over too soon and missing the rule of 55. This one surprises a lot of people. If you leave your job in or after the year you turn 55, you may be able to access your 401k funds without the 10% early withdrawal penalty that's applied when you try to pull from your retirement accounts before age 59.5. It's called the rule of 55, and it can be a great tool if you plan to retire early or just need a bridge between jobs. But here's the key. The rule only applies while your money is still in your employer's 401k. Once you roll it over to an IRA, that flexibility is gone. Withdraw from an IRA before 59.5 and you're back to paying that 10% penalty. So before you rush to roll everything over, think about your short-term income needs. If you're between 55 and 59.5 and might need access to some of those funds, consider leaving part of your money in the company plan until you reach 59.5. It's a small detail, but it can save you thousands of dollars. The third and final mistake, missing out on tax breaks with company stock. Now, this situation is a little more advanced, but it can be a big deal for people who hold company stock inside their 401k. Let's say you've worked at the same company for years and you've built up a lot of shares of company stock in your retirement plan. When you roll that 401k into an IRA, you might be tempted to just move everything together, including cash and the stock. But there's a tax strategy called net unrealized appreciation, or NUA for short, that could save you a ton in taxes. Here's how it works. Instead of rolling your company stock into your IRA, you can move the shares into a taxable brokerage account. You'll pay ordinary income tax on what you originally paid for the stock, known as the cost basis, but any future gains are taxed at long-term capital gains rates, which can be much lower. If you move the stock into an IRA instead, every dollar you withdraw later is taxed at ordinary income rates, which could be as high as 37%. So depending on how much the stock has grown, the NUA strategy can lead to major savings down the road. Of course, this one's not for everyone. It takes careful analysis and planning to make sure it fits your situation, but it's a powerful option that many people overlook. Now, to make sure you're being as tax efficient with your retirement money as possible, click the link in the description or scan the QR code to get a free review from us. Our short survey asks you questions about your unique financial situation so we can record a custom video with personalized recommendations. To learn more about all the options you have with your 401k at retirement, click here to watch our other video covering them. We'll see you there.